welcome to day number 47, and today I want to talk to you about dividends. As you might recall from our first lessons, when we are dealing with stocks, we actually have two components of making money, and these, by the way, are the only ways to make money anyway. So the first one is capital gain. That's when we buy a stock at a low price and we sell it at a higher price. But here we want to talk about the second way to make money with stocks, and that is called cash flow. So the company has the goal to make money, so they produce products, they sell services, goods, whatever they do, and then they have their earnings, and part of their earnings they will then spend on so-called dividends, which is you as a share owner who are eligible to get money from the company's earnings. So you get a payment depending on where you are. In the UK, for example, you get a payment of twice a year. So 2 times a year you get a dividend payment. In Germany and most of Europe, it's typically one time in a year that you get a payment from dividends, and in the US you typically get quarterly dividends, although there are some stocks that even pay out monthly, which are quite rare, but they all have in common that they pay out some money. Now, every time they pay out, you get affected, and I want to show you how it affects you. First of all, if you are in a position, let's say you have a company, let's call it example company, and we have a share price of 100, and that's the closing price for the day, and we assume that they then pay out the dividend. So the share price is at 100 where you buy it. Let's say they pay a 5% dividend, so the dividend will be 5. Now, if you think about your account, let's use another color here. So let's say you have an account where you're trading, and let's say you hold 10 of these shares, and your account has 10 times the example share. Now, your account size would be 1,000 here, so because you have 10 of these shares at 100, so you have 1,000. Now, when the dividend payment happens, basically this goes as a cash payment in your account. So the first thing that you would assume is you get 10 times, because we said you have 10 of these shares, 10 times 5, so you get 50 in your account as a cash payment. So most people now think, hey, that's great because I get the payment and now I have more money in my account. This is true in terms of cash. However, what happens at the same time, now this stock here, that will open again, and we open the next day. Now, if the company paid out 5 in dividends, the opening price, so the first price that we will see the very next day is supposed to be 95 in an ideal world. Actually, it's not happening all the time, so sometimes it's less, sometimes it's more. However, in theory, because the company has a value of 100, they pay out 5, so they give away a part of their value, and therefore their price is supposed to go to 59. Now, if you think about it, what happens here is you still have 1,000 in your account, however, you now have 950 in example shares, and you have 50 in cash. So that's the 1,000 we are talking. So in theory, nothing really changed for you, because what you got out of the company's value in terms of a dividend is kind of in your account in cash, but the price will be lower at the next day because that payout happens. So for you as an investor, it usually is a zero-sum game, because whatever you get here in terms of a dividend payment, you will lose in terms of company value. However, in many cases you will see that when a dividend is paid out, the stock appears to many people now quite cheap, which means they saw, oh, that was 100, now I can get something at a value of 100 at 95. So sometimes, or in many cases, people will go and buy that share now again because it now appears to be cheaper than it was before. So that will usually drive the price up again. And sometimes you can see that that dividend gap, when we went from 100 down to 95, will be closed within the next day. But there's a huge but, and the but is what governments do with it, because if the company pays out dividends, you will have to pay taxes out of it, because if you get 50 out of the stock market, the government or the taxman will say, hey, thank you very much, I want my share of it. And depending on how many taxes you get, you will not receive the 50, although your stock price might go down to 95, but you won't receive the 50 because part of it goes out to taxes. So we can say minus tax. And that is one of the reasons why I personally am very, very careful around these dividend payouts. Because some countries have very small taxes. For example, if you are invested in the United States and as a foreigner you hold a US company and they pay out dividends, then you can sign a form and your tax will be reduced from 30% to 15%, so you don't lose that much. If you are let's say trading German stocks, they will deduct 25 or 26 point something percent from you, which is a huge amount compared to other countries. For France or for French companies, it's 12.8%, depending on which company you hold and whether you are a tax resident of France or not. So you gotta be a little bit careful about these things, because this makes you pay taxes while you still lose the same amount here, which leaves you sometimes at a negative. However, if you think about it, if you hold companies, very good growing companies, for a long time frame, these kind of dividend payments can be an income for you. That means you could basically live from it once you ramp your account up. So you do capital gains, you trade, you make money with buying and selling, and then part of that money you put into long-term holdings, and these long-term holdings start to pay you dividends, and they sooner or later will give you, let's say, a quarterly dividend of 20,000, 50,000, whatsoever, and then you have an income of, let's say, 100,000, 200,000 a year. So you don't have to worry about how much money you make from whatever source, because now your long-term investments will pay for your lifestyle, and you can still go on trading, making more and more money, and put more money in these kind of investments, these long-term stock markets. Now, there's one thing that you got to be aware of. We had a concept where we said when we short the markets, and we will talk about that a little bit more detail in one of our next sessions, but basically we have a tool where we can say, okay, we want to make money when the stock market goes down. And in that case, because you get the benefit through that dividend payout, so let's say you were shorting this share, and while it would go down to 95, you would be profitable, because if you would buy it back now at 95, you would make 5 per share or 50 here. That is why when you're short in a position in a company and they pay out a dividend, you will have to pay the dividend out of your account. That means whoever gives you the share in order to sell it, so you sell something that you don't have, later on you buy it back. We'll do all of this step by step in one of our next videos. But then you have to pay the dividend, because the other party that originally owned the shares will kind of lose out of it, so you are compensating that. either way, dividends should be, in theory, a zero-sum game, because whatever the company pays out or whatever you have to pay out if you're in a short position will be what you either get or what your stock is up or down. So in theory, if we could ignore taxes, we wouldn't have any difference. So I hope that was helpful for you. You will see that in terms of prices, let's say you have positive people, so we use these candles that are going up, and then all of a sudden, let's say you have the closing price here at 100, and the next day you will see something that we call a gap, where the opening price starts at 95. That is how it looks like in a chart when a dividend gets paid out. So you have a 5 dividend payout, and therefore the stock theoretically goes from 100 to 95. It could be 95.20, 94.80 or whatsoever, depends on, we can talk about how these initial prices are getting fixed. However, in theory, whatever gets paid out, you go down, and it looks like a gap where the stock price jumps from one price down to another price. So that's dividends and what happens in the chart, and how it affects you as a trader in your account. You got some birds complaining outside for some reason, so let's see what they do. We are kind of playing around, so very, very lovely. Anyway, that's it for today. So thank you very much for watching. Hope you don't mind our little bird show, and see you all again tomorrow then from Jordan, and yeah, we will have a look how traveling and trading goes together in a live environment by traveling to the lowest point on Earth. Thank you very much for watching, and goodbye.